Well, hey there, everyone. Happy Thursday, May 28th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you live from Redmond, Washington. It is a beautiful sunny day. It's pretty hot. I know this will not seem hot to many of you in other parts of the country. It's almost 76 degrees here. That is a little more than we bargained for here in the Pacific Northwest. I've got my sleeves rolled up, like that's where we're at. So if you think you have it tough weather-wise, okay, we're sweating it. It's back to like the 50s tomorrow, so and rainy. So that should be a nice break from all this heat. In all seriousness, thank you so much for joining me. We're currently live streaming on Facebook, LinkedIn, YouTube, and X. And if you're tuning in live, welcome and thanks for being a part of the a interactive afternoon, as we like to spend together. If you are tuning in live, you can ask questions all along the way. Just use the comments section on any of those platforms. I can see them here at the studio and answer questions as we go. If you're watching the replay later, no fear. Drop some questions in the comments section on our YouTube channel. We will grab some of those, and we're planning an all mailbag episode tomorrow, and we'll hope to answer one of your questions there. Those mailbag episodes are a ton of fun because I can take a little more time answering some of the thoughtful questions you guys are sharing during the week. I feel like there's no shortage of things to be concerned about or have questions about. That's why we're here, to kind of help you navigate the markets during uncertain times. And as much as the S&P 500 keeps going onward and ever upward, as I like to say, I mean, there's plenty of things that I could cite that are potential issues, right? We highlighted, I think on yesterday's show, the Hindenburg Omen, the Titanic syndrome, both of which have fired in the last week. A shout out, by the way, to my friends at CNBC Arabia. I enjoyed going on the show early this morning from Washington State to talk about market conditions, talk about long-term uptrends, and highlight some of those, warning signs on some classic breadth indicators like the Titanic syndrome. Interesting observations to just share with you today. Number one, technology, not the best performing sector. Healthcare at the top of the list. However, about a half and half, kind of a coin flip of sectors up and down today. The Dow Jones Industrial Average dead flat, kind of similar to yesterday, right? No movement there, even though the S&P and the Nasdaq were up. So this is back to kind of growth over value, large over small. Those are some of the themes that played out here today. Other big observation, those warning signs we talk about, besides things like the Hindenburg Omen, kind of classic structural warning signs, things like volatility, not signing any warning. The VIX is actually below 16. Things like high yield spreads, still pretty narrow. We're not really seeing the bond markets or the options market suggest any signs of instability. Doesn't mean we can't turn lower tomorrow. As a trend follower, my number one job is to define the trend. Trend remains positive, or as we like to say, innocent until proven guilty. All right, let's look at some market updates together. We will look at the heat map and talk about some sector and group themes, and then we'll finish off with some stocks and other charts that I have hand selected. Number of interesting kind of individual stocks I wanted to share with you, with some good demonstrations of kind of classical technical analysis, which I always think is fun to feature. All right, here. So the Dow flat for the day, did close above 50,000 yesterday, and today we pretty much just been choppy, sloppy sideways. So still kind of stalling out right below 50,700, not too far off of all-time highs, but kind of no longer advancing in the way the other indexes are. S&P 500 up 0.6%, Nasdaq Composite up 0.9%. Mid caps and small caps all flat for the day, similar to the Dow. Now, those three indexes, the Dow, the S&P mid cap, the S&P small cap, all opened a lot lower, as you can see from these kind of gaps down at the open. Had a quick recovery in the first 90 minutes of trading, and then it was kind of sideways on into the close. Here's the VIX, which just continues to kind of go lower. So, VIX down below 16 is a classic low volatility uptrend. We haven't been this low on the VIX probably since February, maybe January, I would say. I did grab the chart, so I can look at the chart here in a minute and we'll look at it. But I'm guessing it was probably early Q1 was the last time we were down this low. Pretty rare to get a VIX down in the mid-teens, right? Sort of in the 16 to 18 range is pretty standard for a normal kind of bull market conditions. So now we're in a very low volatility environment. What's great about the VIX being so low is that any uncertainty is most likely going to cause a nice little spike in the VIX. It's not going to be hard to detect when feelings of uncertainty, when feelings of fear start to emerge, because the VIX will very quickly start to rotate higher. And I think that could end up being one of the most important charts kind of keep a watchful eye on. We promised to do so here from Redmond, Washington, and give you updates anytime I see some changes there. For now, still a low volatility environment. Interest rates, kind of an interesting day. Bonds actually opened lower and closed higher, kind of similar to the major equity averages. So as a result, interest rates opened up a little higher. The 10-year yield at the open was just over 4.5%. At the 3 p.m. Eastern bond market close, we're back down around 445, 446 on the 10-year yield. So it was sort of a bearish outside day is what you'd probably call the chart of the 10-year treasury yield. Out of the open, it looked like we might get some resumption of that uptrend in rates. We're actually getting a bit of a pullback here in rates. Generally across the yield curve, continuing to drift lower. The shorter end of the curve continuing to kind of pop a little bit higher as bond investors are sort of pricing in some rate hikes through the remainder of 2026. I think still two sort of pricing into the futures market. So bonds higher, rates lower, yield curve flattening. That's been the general trend today. Dollar down slightly, but not a big movement there. Nice bounce for gold. And I would say that was another thing I meant to mention in the intro comments. Bounce of gold off the 200-day moving average could end up being a very important level. Had a number of my premium members write me about that particular setup. I think it's a really interesting setup. My concern is if we get below the 200-day moving average as a trend follower, I tend to just assume that that's bad, right? Above 200-day moving average is good, below is bad. That's a basic premise of how I generally think of price structure on a chart. Having said that, in terms of actionable points, gold's been coming down for quite some time. Gold's come down quite a bit from those previous all-time highs, hitting the 200-day today, kind of bouncing off of there. There's only about a 1% jump in the GLD, about the same for silver, but that's a chart I think could be an important one to watch because gold just has been underperforming here in the month of May. Is this the beginning of a bit of a rotation? Crude oil prices in the form of the USO down a bit. The crude benchmarks, crude oil futures down slightly today. Natural gas prices continuing to surge to the upside. The UNG was up over 6% today. All right, finally looking at cryptocurrencies, generally lower here. Not excited about the chart of Bitcoin, right? We're kind of breaking below key moving averages. We're sort of, Bitcoin basically was in a big downtrend and then had this nice rotation heading up to test that 200-day moving average from below. Absolutely failed, came back down. Now we're back below the 50-day this week. And that looks like a chart back into a distribution phase. We'll look at that here in a little bit. Bitcoin's currently around 73,500. Ether price is getting closer to 2,000 again, which it was way far away from that not too long ago. That's how much those key cryptocurrencies have come off here. All right, coin flip yet again. I think this is what we said yesterday. I mean, one of the sectors, I think it was industrials, was flat. Then we had 5 up and 5 down, almost the same kind of read today. At the top, we had healthcare and technology kind of positive standouts. The XLV, which is the healthcare ETF, was up 1.4%. Technology up 1.3%. The two consumer sectors both up less than 0.5%. On the downside, some defensive sectors, utilities down 1.1%, real estate down about 0.5%, and a couple other sectors just down slightly today. Brett, kind of neutral, I guess, is how I would generally describe it. I mean, not bad, right? And if you look at the New York Composite Index, generally pretty good. I mean, pretty close to a bullish reading. I think stock charts color codes it bullish if it's above 60% advancers, if I remember right. So we're around 56% advancers to 42% decliners. That's not bad. I mean, that's kind of on the bullish side of neutral. On the S&P 500 large cap index, slightly more negative. It's really more neutral than anything. 47% up to 52% down. And across the different cap tiers, pretty consistent in terms of the reading. So generally, I mean, kind of a neutral day breadth-wise. One thing I'm going to show you in a little bit, though, a concerning lack of new highs as the S&P is making a new all-time high. It's just like not a lot of things kind of going up here as the S&P and the Nasdaq are continuing to mint new peaks. All right, the Microsoft chart all of a sudden starting to bounce a little bit. I don't know if I'm convinced yet. We'll look at that chart together a little bit later, but that was up 3.5% today. Both Meta and Microsoft, which have been undeniably the two least attractive charts out of this basket, both kind of bouncing up here. Not quite breaking out, but really, really close. I would say Microsoft right near that place where I have an alert set where I'd probably start to get interested, but it's kind of testing that level. Broadcom up 1.1% today. NVIDIA bouncing a bit after breaking below key support earlier this week. We'll just check in on that chart as well. I think that's it for the front page. Let's continue on looking at the heat map. As a reminder, looks like we're going up pretty well to Facebook, LinkedIn, YouTube, and X. Hey, thank you, those of you tuning in live. Glad you're able to do it. Love keeping the show interactive and love seeing your comments and your questions as we go. Please, if you're watching it live, drop a question anytime during the course of the live stream. And at the end, we'll try to take a question or two. Anything we don't get to, we'll put it in the mailbag. Planning an all mailbag episode for tomorrow. Already some good questions to highlight for you. And we'd love to feature yours as another one for tomorrow's episode. So yesterday we were looking at the heat map. And if you remember, we spent some time on the technology sector because there was sort of some noticeable lack of participation there. Today, kind of back to more of a normal day as what we've seen here in recent months, with a lot of the big names doing pretty well. Microsoft, of course, stands out. AMD, not as much the semiconductors, right? I mean, if you look at things like Intel, LRCX, KLIC, those are all semiconductor names that were not particularly strong today. The strength is really in more some of the software names, right? Things like AppLovin, Palantir actually up today, 8%. That's pretty good. CrowdStrike continuing to press those all-time highs. Hey, even solar, FSLR, making a close above 300. I don't remember the last time I've talked about First Solar. That name kind of fell off the radar completely. And I remember this move in particular. You had this weird gap down. This was actually a pretty reasonable gap down, right? This was at the beginning of January. So sort of at the end of December, I remember thinking First Solar looked like just this great consistent uptrend. Then it's one of those classic moves where you flip the calendar to January and then everything changes. That happens a lot. And investors came out of the holidays thinking, yep, solar stocks are off the grid, off the happy list, and started to drift lower. This is the gap that was kind of an interesting one. This was in February. We gap below the 200-day. And then from there, it's just been kind of sideways. It did establish support around 185. It did kind of break above there. It did clear the 200-day moving average before pulling back. But then the last week is when it's really accelerated to the upside. And here we are, up another 10%, new all-time high for First Solar, closing above $300 a share. And if you zoom out to the weekly chart, you can see how important that is. That's not just breaking above these levels. That's actually, just ticking above this peak from Q2 of 2024. That's 2 years ago. And so we're finally clearing that. So on the weekly chart, this seems like a pretty meaningful breakout. So if you've been ignoring solar stocks like I have, maybe this is a wake-up call to kind of revisit that space and see if there's some things you want to focus in on. But obviously, I would say point number one, looking at the heat map, a return to the strength in technology. Second point on the heat map is about healthcare, right? The XLV outperformed the XLK, right? So healthcare actually outperformed technology today. And I think that says a lot when you think about the big, huge names in technology versus the relatively not so huge names in healthcare. There's some large cap names in there for sure, but not dominant market cap wise like you see in some of the growth sectors. Eli Lilly, of course, has been one of the strongest performers here with some of the the weight loss drugs that have become sort of central to a lot of discussions these days. Eli Lilly up another 4% today, but we can see a bunch of other charts in here starting to have some interesting upward moves. A lot of these are charts that have been beaten down. I mean, if you look at the names that are up a lot today, it's not a lot of great charts, right? I mean, it's charts like DHR. Danaher has been in a serious downtrend all through 2026. Arguably making a nice bounce, but is it enough to feel like that's a great chart yet? Like not as much. I would personally be more interested in two kind of names in healthcare if I'm looking for just interesting charts. Vertex stands out to me because it's starting to rotate from a clear distribution period in March and April to now into more of an accumulation phase. And I like the fact that it's sort of holding the 200-day moving average. I think that's something to think about. The other one that I was going to grab was forget which one of these I was looking at before. Waters, that's it. WAT. And fun story about Waters Corp. Shout out to one of my early mentors in my career, Sean Waters. We worked together at Bloomberg. I started just a little bit after he did, but he was my first mentor in technical analysis. He was one of the first guys I worked with that really knew charts better than I did. And I peppered him with questions, probably annoyingly so. And we worked on some groups together early on. And then I ended up moving on to other things. But I would say my career as a technical analyst started with discussions with Sean Waters, and he would always bring up Waters Corp in presentations and joke that it was his namesake. Probably the same reason I brought up Dave Corp when the chart looked really good as well. But we digress. What I like about this chart, again, the gap above the 200-day was interesting. This was sort of a concerning development there in mid-May, but I like the fact that we've recovered back above the 200-day. Now all of a sudden it looks like some nice higher highs, higher lows. We're bouncing off that higher low in May. Now making a new 3-month high. That's when it starts to pop up on my screen. I regularly scan for stocks making new 3-month highs as a way of just identifying emerging strength. I like the fact we're breaking to a new 3-month high. I like the fact that the momentum has been generally positive in May. I think that's an interesting setup. So, if you've been ignoring healthcare, I don't blame you even a little bit, because a lot of those charts, and I would argue, are still not in a great place. But what I would start to do if I'm looking for ideas in that sector, start scanning for stocks making new 3-month highs and just focus on the healthcare sector. They're there. It's not all of them, and a lot of them I would say still are not great, but there could be some opportunities there. What else? Boy, talk about a nothing burger of a day for communication services. Alphabet and Meta, which are the two big names, and then even through Netflix, T-Mobile, Verizon, Disney, AT&T, they were all flat and some slightly lower today. So, not really seeing a lot of participation on the offensive or defensive side of communication services. Final observation, maybe, and then we'll go to some charts, because I got a lot that I started to grab. I had to kind of cut myself off because I was grabbing too many names. We're just not going to have time for all of them. The last observation I was going to say was in the consumer staples sector. We've talked about some of the beverages names, and charts like Coke have been favorites of mine. Just in the month of May, seeing them start to resume the uptrend phase. I'm noticing the dollar names. All right, Dollar General still kind of in a downtrend. It looks like some of the healthcare names I was just looking at. Dollar Tree has gapped above the 200-day moving average. Grab that chart to talk about. It was a big gap today, and I think that's an important chart to focus on to see if it's able to hold that 200-day moving average here going forward. All right, before we continue on, I do want to give a shout out to one of our friends at Koifin. If you go to marketmisbehavior.com/Koifin, you can learn more about their powerful analytical tool. There's a lot of great features in there for individual investors, but especially if you're a financial advisor, and I know many of you are in a position where you're managing other people's client portfolios. This is really where the product kind of shines. There are other products that are out there that are very widely followed. I've learned a lot about Koifin over time, and have worked with the founder of Koifin, and I'm impressed with the analytical platform he's put together at such a low cost relative to other platforms of this quality. Really good dashboards to help you visualize what's happening in the markets. One of my favorite features is the ability to dig into ETFs to look at their holdings. I run this multiple times every day. When someone asks about an ETF that I don't really know a lot about, I immediately go to Koifin to look at what's in there, look at the sector bets, run a quick attribution analysis to see where the returns have really come from. I'm not big into fundamental data, but there are times when I want to dig into revenues and margins and earnings and things like that, and valuations, and having the ability to go into deep financial statement analysis when I need it is super important. And so having that as a built-in capability is very, very good. Also, wide coverage of the street and changing expectations there. One of the really interesting selling points of the product that I found is when advisors were surveyed a couple of years ago about which kind of major platform gave the most value relative to their cost. Koifin by far outperformed some of the other platforms that you see on here. We have a great relationship with Koifin. If you go to marketmisbehavior.com/Koifin, they'll give you 20% off a new account. I'd encourage you to check it out. It's well done. It's a great team of thoughtful practitioners that created that platform. And I wish you much success as you do so. All right, let's look at some charts together, shall we? We're going to start with the chart of the S&P 500. Kind of added this little blue line here. In an uptrend, if you followed my webcast earlier this week where we talked about stops, one of the basic premises we talked about was in an uptrend phase, all you do is you keep bumping up your stock bump up your stop to the most recent swing low. So in an uptrend, we make higher highs, we make higher lows. Every time we make a higher low, you kind of move the stop up a little bit. It's a very manual process, but a very easy way of just confirming, do we keep making higher highs? Do we keep making higher lows? So I've bumped up that sort of initial stop up to the most recent swing lows from early mid-May. That's around 73.40 on the S&P. So by my reading, anything above there is kind of fine, kind of normal noise. Anytime the S&P would break below 73.40, I'd start to at least revisit, how bullish is this trend if we're undercutting the recent swing lows. By the way, that webcast is still available. If you missed it, it's not too late. Go to marketmisbehavior.com/exit, EXIT, to check out that free webcast called The Art of the Exit. That'll be available for everyone through the weekend. And then the beginning of next week, we'll put it in the archive, only available to Market Misbehavior Premium members. All right. I mean, look, in an uptrend like this, my main goal is to define the trend. The trend's up, right? That's undeniable. Stocks are going higher, right? And in the form of our major benchmarks, right? And that's not debatable, right? The S&P and the Nasdaq are making new highs. The trend is pretty healthy. It's good. But I've also been trained to think like a contrarian and look for things that would make me start to question the strength of the uptrend. We highlighted that recently with the Hindenburg Omen and the Titanic syndrome. Those are flashing initial warning signals. Anything to take away from this week, this at the bottom is the number of new 52-week highs in green and the number of 52-week lows in red every day. And this is for the S&P 500. And then the next panel up is for the NYSE, right, for the entire New York Stock Exchange. If you look at the bottom one, which is the S&P 500, last couple of days, we've been pushing to new highs, but we have less and less stocks, individual names also going to new highs. In a healthy bull market phase, we want an expansion in new highs. We want more and more stocks breaking out because it represents a broad advance. That represents healthy participation. That implies that it's not narrow leadership, just Micron and CrowdStrike, and that's it. It implies that there are more and more stocks representing more and more investor optimism, which is usually what can create a sustainable bullish trend beyond that break to new highs. We're not getting that here. Now going into Thursday's session, we had about 3.5% of the S&P make a new 52-week high. I would much rather see things in like the 10 to 20% range, right, of stocks individual names making new 52-week highs. So just not a lot of participation. The bull case from here, I would argue, would have to show a lot more green on these charts, representing that more stocks are making new 52-week highs. We're starting to cool off here as the week progresses. But, again, is there a lot to worry about? Bond market is saying no. Options market is saying no. The top panel here, and I zoomed in a little bit, top panel is looking at high yield, what's called high yield option adjusted spreads. These are basically junk bond spreads. So the spreads on the debt of risky companies, right? Junk bonds or high yield bonds. When those numbers are very low, that means the bond market's not seeing a lot of danger right now. Bond investors tend to be really attuned to potential risks because their whole game is how likely is it that these companies are going to be able to meet their debt obligation? We're going to be able to pay those coupon payments. And when spreads widen, that tells you the bond investors are like, all right, conditions are getting worse. I'm a little concerned that these, high yield companies, these risky companies are going to be able to meet their debt obligation. We're not seeing that. We're actually seeing spreads remain relatively narrow, which implies bond investors are thinking, yeah, things are good. Volatility remains pretty narrow as well, right? The VIX is below 16 today. We can see on the chart here, January. Yeah, that's what I was thinking. It was like January, February. So January was the last time that the VIX was below 16. As you can probably tell, both of these top two charts are plotted upside down. I plot them inversely because then they match the move in the S&P, which is the bottom series. So if spreads are widening and if the VIX is going up, that usually means stocks are going down. So I kind of lined it up this way to visually line up. As we can see, spreads are pretty narrow. That the narrowest levels we've been in for the last 12 months. The VIX is pretty low. The VIX is at the lowest levels we've been for the last 12 months, right about. So those markets are telling you not much to be worried about. I'll let you know when that changes, but for now it's not. Here's the VIX itself, just so we can confirm. There's the January levels down at below 16. This purple line is 16, just so you can see going back. So, in summer of last year, in the fourth quarter of this year, beginning of January, we also had a VIX down in this range. VIX spiking above 20 is where you want to start to think about a potential pullback scenario. We saw that in October, November of last year. We certainly saw that in February of this year, which was a great warning sign for that pretty painful March. So let's keep a watchful eye there for any sort of upside rotation. For now, volatility is telling you pretty good. Another thing that I look for, and again, just to show that the conditions are generally pretty positive here, I would say from the technical side, defensive sectors really are not performing relatively well. We highlighted healthcare was the best sector in the S&P today. If you look at the relative performance of the XLV, and that's the second panel down, kind of in this dark blue color, you can see that the healthcare sector just slightly outperforming over the last couple weeks, but utilities making a new 12-month relative low today. Consumer staples making a new 3-month relative low this week. Real estate very close to making a new 3-month relative low here yet again this week. So most of the defensive sectors are not really performing well. These are good series to watch because if these lines would start to turn higher, that would imply that institutional investors are rotating to more of the defensive side of their mandate as opposed to remaining on offense, right? If you're an equity portfolio manager, you run a $20 billion fund. If you're nervous about the markets, you can't just go to cash because your shareholders want you to own stocks. That's what they're paying you to do. So the best thing you can do is get as defensive as you can, which means a lot of investors running those big funds would go to things like utilities and real estate, kind of lower volatility, higher yielding areas of the market. Great place to hide out if you're concerned about potential bear scenarios. We're not seeing any signs of that kind of defensive rotation. So, those warning signs I'll highlight when I'm seeing them. I'm not seeing them. All right, let's talk about sentiment a little bit. Bit of a change here on the AAII survey, but not much to talk about. So I don't want to spend too much time on it. Up to 36% bulls. That's well below kind of the danger levels. Above 50% bullish is where I start to think, ooh, that's too much. We're not there. We're kind of middle of the road bullish reading there. The bearish reading is down around 42%. So still, even with the S&P and the Nasdaq making new all-time highs, not nearly as many bulls as you might think, particularly in the AAII survey. It's more bears than bulls still. One of the important changes to highlight for you today is the Name Exposure Index. This is the National Association of Active Investment Managers. It's a group of money managers, wealth managers, and so forth that participate in a regular survey asking about their allocation to the equity space. It's coming in at 90% allocation. Anything above 100%, I've learned, is probably a little too high when the respondents in that survey are net leveraged long, meaning an over 100% exposure to equities. And in the survey, you can actually go up to 200% long. So like a full, double or like a levered position. We're at 98%. We're very, very close to getting above 100%. Last time we were above 100% was in December. That was just before, obviously, the deterioration. Market moved higher, at the beginning of Q1. But I think that Name Exposure Index getting above 100% was one of those warning signs that stands out to me at the end of last year that kind of told me maybe we were going to have some trouble in Q1. So not quite there, but a big jump higher this week to note. All right, chart of gold at a really interesting place. And as I mentioned, I got some emails about this from my premium members. We've hit the 200-day moving average. We actually haven't hit the 200-day since, way beyond the beginning of this chart. This chart goes back about a year. We got close here in March when the equity markets were selling off as well. Nice bounce up to the 50-day. After these failed tests of the 50-day moving average, we're kind of right back to the 200-day moving average. Is this the kind of chart I would think about taking a shot at? Probably. I like charts like this that are pulling back to an ascending 200-day moving average because I think the trade, in terms of the structure of the trade, using technical analysis, pretty straightforward, right? If I'm taking a long position here, which I already had a long position, so this is not a trade I'm actively making. I own GLD and IAU at the moment in my own portfolios in terms of disclosure, but bouncing off the 200-day, this is kind of the time where it would make a ton of sense. We kind of get below here. We get gold down to like 4,300. That means the 200-day is not holding. That means I would argue whatever, that's kind of like the stop is triggered. 200 days not holding, look out below. Like this could go a lot further. But for now, we're kind of at that last level where you could reasonably expect some sort of bounce, and I think justify it using the technical tools that we've talked about. Great way to validate a bounce would be a push above the 50-day moving average. That's where previous bounces in April and then earlier this month in May stalled out. So that's something we'd be looking for. Definitely want to see better momentum as well. So a breakout with an RSI pushing above 60 would really indicate a change of character. Not there yet. I'll tell you, one of the other really interesting features of the market here as we start to get to the end of the month, and I'm preparing to do my monthly chart review for my premium members. That'll probably be at the beginning of next week that we'll put that out. But it's kind of a chance once a month to take a big step back from the monitors, a big deep breath, and sort of reflect on what has really changed. Cryptocurrency, particularly Bitcoin and Ethereum, just not participating in the uptrend is a noticeable divergence. Where if you look back in like April, it's like stocks recovering, Bitcoin recovering, kind of back to a risk on kind of feel. In mid-May, kind of looked pretty good as well. And Bitcoin threatening its 200-day moving average. It stalled out. Now it broke below the 50-day and just accelerating lower this week. And so think about what that chart looks like, and then think back to the chart of the S&P 500. I mean, night and day difference. So cryptocurrencies are a pretty good proxy for sort of speculation. It makes me wonder how much of that great uptrend in the S&P is not because of investor enthusiasm, but more because of liquidity injected in the system and all those things that are sort of artificial reasons why the market could be going higher. That makes me wonder for sure. All right, chart of NVIDIA we highlighted yesterday. We'll just keep our NVIDIA watch going here. Yesterday, we talked about the close below the 21-day EMA. Today, we did bounce up slightly, closed almost precisely at the 21-day EMA, so still potentially in play. We've broken down through that trend line, so generally I see this as a failed chart, as a breakdown until we get some sort of recovery, but we're not really following through today, which is one of the things we often would look for. Microsoft, as I mentioned, kind of right up against that point where it starts to look like a really encouraging chart. I have no problem avoiding a Microsoft in this sort of environment because we've stalled out at the first Fibonacci level. It's around 430. We've had a number of tests of that level, and we just have not broken out. So on a chart like this, I think it's super straightforward. It's like, I'm going to wait patiently until we get a valid break above 430. That's the trigger telling you something's new, something's different. Buyers willing to pay a little bit more. If we do break out, I'm immediately eyeing the 200-day moving average, currently sitting just above 456, but 430, that's an important level to watch, I think, on Microsoft. All right, Snowflake gapped up big time. This was obviously a pretty good jump. You know, we've been looking at the chart of Snowflake after this point, right, when we started rotating. So I wanted to highlight this chart just to demonstrate what I call the, different phases, right, or the different types of trends, right? A market at any point can be in an uptrend or a downtrend or a sideways trend, or the language I usually use is an accumulation phase going up, a distribution phase going down, or a consolidation phase going sideways. Clear distribution in the fourth quarter of last year through really the beginning mid of April, as we keep making lower lows and lower highs. We keep failing to hold moving averages, failing to hold support. I've drawn a trend line kind of loosely based off of these major highs over that 6-month period. Then all of a sudden we go sideways. We bounce up against 155 a couple times here. Finally break above that trend line resistance. I would argue this is sort of a consolidation phase where now we're no longer making new lows. We're just sort of consolidating. But then look at the accumulation phase. We break above the 50-day. We make higher swing highs. We start to break above resistance. We're making higher lows. Starts to be pretty interesting. So this is where we start to think about maybe an initial bet because of that breakout. And hopefully that means we can participate in a big gap higher like we saw today. So what do you do now if you miss Snowflake? I would say after a gap like this, tomorrow means a lot because now we've, basically had a big 36% upgrade to the price of the stock. Now, all of a sudden, we're threatening previous highs from Q4 of last year. Tomorrow can tell you a great deal into the beginning of next week. After that gap, do we see additional buyers come in, or do people start cashing out after this big windfall of a 36% rise today? So open question. Johnson & Johnson, very, very close to breaking above a trend line. I just want to highlight this for you. If you take the major highs so far this year, we've been in a clear distribution phase, lower highs and lower lows. We're right up against the 50-day. We break above that trend line, maybe worth considering that a new breakout phase and a new uptrend. Would love to see the RSI get above 60 there. So we focus a lot on Eli Lilly, one of the better charts in healthcare. Johnny John maybe starts to participate in the uptrend as well. Maybe there's a big pharmaceutical trade leading in going into Q3. We'll see. We'll see what happens with the chart. Similar with Snowflake, Dollar Tree with a big gap higher today. It was up about 18%. It was up even more earlier in the day and ended up stalling out around 50% of the way back up to the January 2026 high. We were up around 143 there. We got down to around 85. We then bounced higher. Today's gap takes us above the first Fibonacci support and above the 200-day moving average. On a chart like this, the 200-day for me immediately becomes like that first line in the sand. This is a pretty good chart and an encouraging breakout if and only if it can sustain that move above the 200-day moving average. That is the question I'll be looking for tomorrow. All right, let's take a question or two. I love this. Snowflake needs to be renamed to Blizzard. Man, I'm a long-time World of Warcraft player. My character on World of Warcraft, my first character, older than my daughter who just graduated from high school. So that shows you how long I've been off and on playing that one. But should be a lot of fun. All right, Larry, thanks for watching. Dave, would you agree that the chart of CSX is a good chart? Yeah, CSX, one of the railroads, right? We highlighted, I think it was CSX, maybe UNP, I forget which one earlier this week. There's a negative regulatory ruling against a different railroad that caused selling today, just so you know. Thanks for highlighting that. What's so funny is I often will get questions about charts that have had some sort of regulatory filing. You get that a lot with like healthcare names, like with biotech, right? You get a big judgment or something. What I don't blame that. I think that's a reasonable and very fair question and great to ask. All I would tell you for anyone listening is remember that when you hear something like, oh, there was a regulatory, decision, what does that mean for the chart? Make sure that you separate those two, right? Your assessment of what that change in the regulatory environment means for the company should be one set of analysis. What does the chart look like should be totally independent. And I found, having coached and taught, analysts who are trying to learn technical analysis, whether they're fundamental analysts in particular, would often struggle with this. They would look at the chart and they would just see like the quarterly earnings and they would think about all these news things. And I'm like, you are letting a bunch of other stuff cloud your analysis of the chart. Analyze the chart on its merits. Analyze the trend, analyze the momentum, analyze the relative performance, analyze price patterns, then compare that to an independent analysis of the fundamentals and the news and the quarterly filings and the earnings. Then combine the two. Are we in agreement? Good company, good stock, bad company, good company, bad stock. Like if you overlap those two too much, and I'm not implying that you're doing this on your question, but it seemed like a good time to share that takeaway because that's something I found people often run into. Don't let your knowledge of what's happening with the company affect your ability to analyze the chart on its own, because a lot of times good charts will tell you something the filings will not, and that's my thoughts. What do we think about the chart of CSX? Well, first off, we're making new all-time highs. Most recently, we're pulling back to the 21-day EMA. So I would say from a pure price structure, pretty good, right? Higher highs, higher lows. We're above upward sloping moving averages. We pulled back to the 21-day EMA, but we haven't broken it. Moving averages all slope higher. So I would say in the top panel, pretty good chart. I would think, hopefully you agree. The problem I have with this chart is right here. And this is what I'm seeing on not just this one. There's another chart that this makes me think of. And oh man, I look at too many charts to remember individual tickers. Some people I've worked with, like Tom DeMark comes to mind. He was like, photographic memory. He would remember some chart he was looking at a week ago. I can barely remember what ticker I was looking at 10 minutes ago, like earlier in the show. That's how hard it is for me. I'm a visual guy, but I'm like, and analyze it visually. And then my brain releases that data. So I'm always envious of people that can do it. So there's another chart that this reminds me of, and I can't for the life of me remember what it is, but this is not the only divergence that I've noted. And I would say that's the problem, right? The new highs, if there's any issue, the asterisk to that new high is that the momentum isn't strong enough. Arguably you can see that with the S&P right now, that we're making new highs and the RSI isn't quite doing that just yet. So that would be the only warning sign as a potential bearish momentum divergence. So that's more of a leading indicator, would have me a little bit cautious here. But in terms of the trend, in terms of the moving averages, the patterns, pretty constructive here. Those swing lows, the gaps right around 44. That's probably a level I would be watching if we would break the 21-day EMA. Thanks for asking about that, by the way. That was a pretty interesting chart. What else? Ooh, shout out to Northeast Ohio. We're asking about Eaton Corp, ETN. Great chart. Thanks for asking about this. Would you say that Eaton formed an inverse head and shoulders pattern recently, and failed to go up? Would you buy now because it is in an uptrend and just crossed above the 21-day EMA? Yeah, so I think what you're talking about, it's hard to tell when I can't see the chart you're looking at. I'm guessing you're calling this like a big inverted head and shoulders, maybe, right? Like a head and a left shoulder and a right shoulder, and you're seeing this as like a breakout, maybe. And if you're not looking at that, I'm really sorry. I don't understand. I don't look at this chart and immediately see inverted head and shoulders. So I'm curious what you're seeing in particular. But that's the closest thing I could detect that looks kind of like an inverted head and shoulders pattern. This would actually be an inverted head and shoulders continuation pattern, which is when you have a big uptrend. This is more often happens like at a bottom. So this would be like a big rally, and then this kind of continuation pattern. The breakout and then the pullback, and now we're kind of chopping around in here. I mean, so for me, regardless of whether you label it that, clearly there's like some resistance. And I guess the way I would label this chart is I would do this. I would look at this chart and say, here's kind of this range. I do like something like this. And I'm doing this quickly and crudely just for brevity, but I'm seeing this as like here's the peak in July, here's the peak in October, here's the peak in February. Obviously, we're kind of, hitting this point a bunch of times. We hit it again in April, we break out. So that right there looks really good. That would pop up on my new 3-month high screen. I remember highlighting this chart to someone, maybe to my premium members when it made a new 3-month high, because I run that scan all the time. And I remember ETN coming up on there. What we haven't really had is we had sort of this breakout, retest, and then we just keep kind of failing. And so now we're kind of right in the middle of the breakout here. So if I had kind of taken a position here, I probably would have gotten stopped out back down in that push down to the low below the 50-day moving average. Would I be re-engaging with it now? I mean, like, probably not necessarily, only because it had a failed breakout, and now I'd probably be looking for a different chart to think about. The moving back above moving averages is good. The momentum, though, is relatively neutral, right? The RSI is kind of right around 50. So this really is, it's kind of settling in right to the breakout range. So, probably, honestly, I probably wouldn't. And I would think of this as I don't know if I would call it an inverted head and shoulders. I would definitely call this a breakout that failed pretty soon afterwards. And that, to be honest with you, I don't see that as a failure. A lot of people see a chart like that and say, all right, well, obviously breakouts don't work very well. Nothing works all the time. And anyone that tells you they have something that does, they're lying, because nothing really does. What you want to do is use things that work more often than they don't, ideally. And when you're right, stay right as long as possible. And when you're wrong, acknowledge that and admit that as quickly as possible. I think that's the game. It's not about predicting the future. It's about recognizing the changes in the chart, the changes of character, as we like to say. There we go. Hey, thank you guys so much for those thoughtful questions. Thank you, those of you watching live here on the live stream. Great to have you with me. If you're watching the replay on our YouTube channel, hey, welcome. Take a moment, hit the like, the subscribe, tell 1,000 of your friends. All of that helps a great deal to get a message of mindful investing out to other like-minded investors. Have a great evening. We'll have an all mailbag episode tomorrow. In the meantime, have a good night. And remember, it's always a good time to own good charts. Take good care, folks.